Okay, so thanks a lot to the organizers for putting the paper on the program. This is joint work with my colleague Marcin Kacperczyk, who is also at NYU Stern. So what's the research question? So the question we're asking is, what explains risk-taking of money market funds? And one way to motivate this question is to show you this graph. So what is this graph? Here I'm showing you what are the returns to money market funds starting from 2002 up to August 2008, before Lehman. And the graph would sort of look very similar if you sort of extended it back in time. And I'm showing you the dispersion in money market fund returns. So I'm showing you what's the return to the 95th and 5th percentile. And what you see is that basically up to August 2007, most money market funds paid similar returns and we interpreted as took similar type of risk. So there wasn't much dispersion. It was somewhere between the high and the low performing, somewhere between 20, 30 basis points. But starting in August 2007, you see that there was an increase in the dispersion. So there were some funds which in some sense continued to be safe and had low returns. There were other funds which managed to get high returns and we think took on a lot of risk. So the question we're asking is, what's going on here, both in the time series and in the cross-section? In particular, why are there some funds which take a lot of risk and other funds which don't? Now, the reason why we're interested in this question is we believe that money market funds are sort of a large, important industry. So in 2008, money market funds had $3 trillion in assets under management. So at that time, that was sort of same order of magnitude as the entire equity mutual fund sector. Also, money market funds issue demand deposits, and the deposits issued by those funds are roughly the same size of deposits, demand deposits issued by the entire US commercial banking sector. And in some sense, I mean, this sector was deemed so important that when there was a run on money market funds in September 2008 after Lehman, the government decided to step in because they were worried about the risk to US financial stability and decided, in some sense, bail out the entire sector. Furthermore, we think that money market funds sort of provide an interesting window in order to study risk-taking incentives of financial intermediaries. So as will become clearer, all money market funds are affiliated with larger financial firms. And we think our results also shed some light on the risk-taking incentives of those firms. Okay, so let me just briefly talk about the setting. I'm sure you all know about money market funds, but let me just summarize the basics. So money market funds are regulated by the SEC, and they must invest in safe money market instruments. So these are instruments which have the highest short-term ratings, have short maturities, and they have to be diversified. What makes them special, in particular relative to mutual funds, is that once they follow these investment criteria, they can value investment at cost and sell demand deposits with a stable net asset value against that. So a regular mutual fund is mark to market, versus these money market funds, as long as they're within a band around the true market value, they can value the investment as cost, and that what allows them to issue these deposits. So in some sense, they're structured like what some people would call a narrow bank. Now, the main risk for a fund is actually that there would be some sort of run, okay? That everybody tries to take out the money at the same time. And if there's a run, well, that can result in breaking the buck, which means that the money market fund cannot pay off $1 per share. Now, it turns out up to August 2008, this only happened once, and that was a pretty small fund in 1994. And partly why it never happened is in the rare instances where a fund was getting close, often there's the fund sponsor, which is managing the fund, and they decided maybe to put in some capital, provide a guarantee to stop the run. They don't have a contractual obligation to do that, but they have the option to do that. Okay? So you want to see it in terms of a picture. You have a sponsor. That's typically a large mutual fund organization. And they choose a manager. They provide possibly an implicit guarantee, which means they help the fund if it gets into trouble. Then you have this money market fund, which invests in certificate of deposits, commercial paper, asset-backed commercial paper, repos, treasuries, and they issue demand deposits. There's no equity in money market funds. So if there's a run, the sponsor is sort of the only hope. So what variables do we think should affect risk-taking of money market funds? We think sort of the theory We're sort of trying to summarize a big literature here, but it sort of points towards two variables. So one is, financial intermediaries with significant franchise value might take on less risk. So if you're worried that a run has negative effects on the other business of a sponsor, maybe other funds, could be equity funds, bond funds, other business segments of the sponsor. So if there's significant franchise value, you might want to avoid a run simply by taking on less risk ex ante. The other one, there's this option to provide a bailout if a fund gets into trouble. And theoretically, that sort of can go either way. Well, an option gives you more leeway exposed, so maybe that allows you to take on more risk ex ante. But also, if you really think that reputation is important, you kind of have to provide this bailout if there's a problem, well, then you might want to take on less risk. So this, in some sense, is ambiguous. Now, how are we going to try to figure out what's the effect of this variable? Well, our empirical strategy is sort of use the subprime mortgage crisis as somewhat of an unexpected shock to money market funds. So we're going to look in particular before Lehman, although we have some tests in the end. We're also going to look after Lehman. But we're going to sort of think about what happened when the financial crisis started in August 2007. And a lot of these money market fund instruments prior to 2007 had similar yields, but then some of them became riskier. In particular, the reason was that there was a decline in liquidation collateral values underlying some of these money market instruments. And as a result, they became riskier. And there was a strong incentive, and I will show you some data on that, to take on more risk for the funds in order to generate inflows. If a fund is able to generate inflows, they charge a fixed percentage of assets under management to generate more revenues, and that's a way for a fund to make more money. Now, what happened? Which instruments became riskier? Basically, I'm showing you different asset classes, so repos, deposits, bank obligation, floating rate notes, commercial paper, asset-backed commercial paper, relative to treasuries. So what you see here is that all of these instruments relative to treasuries almost paid similar yields up to August 2007, roughly 20 basis points relative to treasuries. However, starting in August 2007, you see this divergence. So for example, repos continue to be safe, paid roughly the same yields as treasuries, versus other instruments like asset-backed commercial paper, bank obligation became much riskier. Okay? They paid much higher yields. And so as a sense, we think of this as an expansionary risk-taking opportunity. Before, a fund was pretty much restricted to this very narrow band of investing in risky assets. Now, all of a sudden, a fund has much more leeway in terms of investing in risky assets. Now, clearly, this shock is going to apply to all funds. So what we're going to do is we're going to use cross-sectional variation in reputation and financial strength in order to figure out what's the effect of this variable on actual risk-taking. Okay? So the explanatory variables we're going to use going to be these measures of reputation, financial strength, and we think a lot of these going to be determined prior to August 2007, and it's going to be unexpected that you're truly going to see this expansion risking opportunities. It's something which hasn't been there since money market funds exist in the 1970s, so it's unlikely that they're chosen in anticipation of the expansion risk-taking opportunities. But if you think they are, we're going to have some identification tests at the end, which hopefully going to convince you that that's not the case. Okay, so let me just summarize the results, and I'm going to show you a lot of regressions later, but I just want to sort of summarize the results as a tale of two funds. So one fund, the Reserve Primary Fund, is one of the oldest funds in the money market fund industry. It was known for its safe approach to investing, and it was sponsored by a management company, Reserve Primary Funds, of reserve funds. And I'm going to compare it with the Columbia Cash Reserve Funds, which is a large, well-known fund, and it was sponsored by Bank of America. And what I want to emphasize is the Reserve Primary Fund didn't have a lot of reputation, didn't have a big franchise value, whereas Bank of America clearly has significant reputation, significant franchise value. Now, what I'm showing you here is basically assets under management and the return on the Reserve Primary Fund relative to the industry average. So what you see is up to August 2007, the Reserve Primary Fund was pretty much paying the same yield as the industry. Then all of a sudden, the yield increased by more than 50 basis points relative to the industry average. Now, as a result of that, you see a huge inflow in terms of assets. So the Reserve Primary Fund was roughly $50 billion in assets in August 2007. Within 1 year, up to August 2008, they increased in size by a factor of 3. Okay? Now, compared with the Columbia Cash Reserve Fund, that's the Bank of America fund, well, what you see is that they also roughly paid the industry average, but then all of a sudden their return actually declined relative to the industry average, and their assets even slightly declined as well. So you might wonder what's going on. Well, if you look at the assets of the reserve primary fund, what you see is the reserve primary fund wasn't holding any asset-backed commercial paper up to August 2007. Well, up to then, asset-backed commercial paper had a really low yield, wasn't considered risky. Then it was sort of became clear it was a risky asset. All of a sudden, the reserve primary fund shifted 60% of its assets into that asset. Okay, so they really changed the asset allocation and reduced the holdings of sort of safe assets like treasuries or repos. Whereas we don't see that kind of change for the Columbia Cash Reserve. So in some sense, what this story is trying to tell you is we think reputation was actually quite important. Now, I say it's not just reputation. You might also want to distinguish that from financial strength. So one thing you might be worried about, well, Bank of America also obviously has much more access to financial resources, so maybe that's what's causing the difference. So what we're going to do is we're going to examine financial strength for pure mutual fund organizations, something like the Reserve Primary Fund, and for financial conglomerates like something like Bank of America. And what we find is that higher financial strength in some sense goes the opposite way. So we find that higher financial strength, if you have more assets or access to assets, what you see is that you actually take on more risk. Okay? So it sort of goes the other way if you think that was explaining our reputation results. So in short, what we find is basically reputation reduces risk-taking ex ante, whereas financial strength actually seems to increase the risk-taking of money market funds. Okay, so now I have you given the big picture. I want to go sort of in the details of the paper. So we're going to get our data from a couple of different data sources. Our main data set is coming from iMoneyNet. That's the data provider within the industry. They collect data on asset values, returns, and holdings. We're going to merge that to the standard CRSP mutual fund data. We also merge it to CompuStar data. And we actually also have data from the SEC on whether a particular sponsor declared support to a fund in this period between there was a run and the government stepping in. So that's going to, in some sense, be a bit of an out-of-sample test for us whether really reputation and financial strength played a role when there was a run. The time period, we're going to look at weekly data from 2005 to 2009, and we're going to focus initially on all institutional prime money market funds. Prime funds because those are the funds which can invest in non-treasuries, non-repos, and institutional funds because they are particularly sensitive to changes in yields. And I will show you some results on that. And we're going to have sort of two reputation variables. So the first one is 1 minus the institutional prime fund assets relative to total assets. So you can think of that measure as saying, well, if this is very high, I have a lot of other mutual funds, so bond funds, equity funds. I have a lot of reputation at stake. So that's going to be at the level of the mutual fund organization. And then some of these mutual fund organizations are going to be affiliated with larger financial conglomerates. Okay, so they're going to have other business segments, maybe commercial banking, maybe investment banking. And we're just going to capture that with an indicator variable whether a mutual fund organization is affiliated with a conglomerate. Okay, so just to give you a sense, what are the big funds in our data set? What you see is JP Morgan, Columbia Cash Reserve, BlackRock. The reason why I put that up is, well, first of all, you see there's quite some variation in reputation, and there's also variation of whether they are affiliated with a large financial conglomerate or not. And it's important our results are not just coming from the Reserve Primary Fund. We can take that out. They're coming very much from differences with firms like BlackRock or Fidelity relative to Bank of America or Goldman Sachs. Okay, so if you look in terms of observable characteristics prior to the expansion risk-taking opportunities, so this is at the beginning of our data set, January 2006, you really don't find much difference in terms of observables. Okay, so the spread is roughly the same, annual expenses are the same, age is the same. There's some difference in size, but it's not statistically significant. The main difference is in terms of reputation, and that's clear because we cut this table like this. Now, what I want to show you is sort of our results in 3 steps. First, they're going to be the expansion risk-taking opportunities. That's going to be the shock which affects all funds. Then I'm going to show you that indeed there are strong incentives to take on more risks. So I'm going to do that by estimating a sort of standard flow performance relationship. And then finally, I'm going to look at the impact of reputation and financial strength on risk-taking by doing a difference in different strategy. We'll look before and after and compare funds which have a sponsor with high and low reputation. Okay, so the expansion of risk-taking opportunity, that's the graph you already shown before. I'm basically just doing the same things in regression. And an easy way to see that, I'm just putting up some asset classes. Asset-backed commercial paper was paying 20 basis points relative to treasuries before August 2007 and 75 after August 2007. It's even more striking for bank obligations, but you don't see that difference for repos, for example. Okay, so the next thing is the flow performance relationship. So here we just regress the flow into fund from time t to t plus 1 on a time fixed effect and whatever is the spread on that fund in the previous week. And we put in the standard controls in this literature. And what we find is that indeed, if a fund manages to have a higher spread, well, then he experiences higher inflows. And this coefficient is actually quite large in terms of economics. So what that means is if a fund manages to increase its performance by 1 standard deviation relative to the industry average over a year, you're going to see an increase in fund size by 37%. So that means the revenue is going to also increase by 30%, and so do the profits, presumably. What's important is, if you think that investors are perfectly pricing these things, you probably should see something on the interactions with reputation or conglomerate, but we don't find much. We think that is suggestive that, maybe depositors in these money market funds either didn't quite know how to price these things, or there was too much of a transaction cost to find out about this. So in some sense, that's the friction we are exploiting, because if investors had perfectly priced all of these things, then they shouldn't really affect risk-taking. Okay, so finally we're going to look at the impact of reputation, financial strength from risk-taking. So we're going to regress a measure of risk-taking on our reputation measures, and we're going to control for fund fixed effects, time fixed effects, and the standard controls. To make sure we really capture risk, we're going to use 3 different measures. So first, we're going to look at the actual holdings. So we're going to look at sort of the holdings of risky shares relative to safe assets. So we're going to define these as bank obligations minus treasuries minus repos. Then we're going to look at portfolio maturity. That's another common measure of risk in this industry. And then finally, we're just going to use the fund spread, which seems reasonable in this industry because there's very little scope for quality or for picking the right type of instruments. But we really want to use those 3 because they're going to capture different aspects of risk. And we're going to use both our reputation variables, namely how many other funds do you have in your mutual fund organization, and are you affiliated with a larger financial conglomerate. And just to show you this in terms of pictures, what you see is that the parallel trend assumption seems to hold, and then really in August 2007, you see that if a fund had higher reputation, they reduced the risk-taking. That means in terms of the holdings risk, so that means they really reduced the holdings of risky assets relative to funds with a low reputation. Okay? You find a similar result if you look at maturity. So again, the funds which are responsive with high reputation reduce the maturity actively relative to funds with a low reputation. And you find a similar result if you look at spreads. Now, you can put that in the standard regression framework, and what you find is that these are statistically significant, both the reputation variable and the conglomerate variable, for most of the outcomes we're looking at, except maturity for the conglomerates. In terms of economic significance, what that means is that a 1 standard deviation increase in our reputation measure leads roughly to a 17 to 25% drop in the cross-sectional standard deviation of risk, so depending on which exact measure we're looking at. Now, one thing I mentioned to begin with is, well, maybe something like this conglomerate dummy could actually proxy for financial strength. Okay? So we want to test for that, and what we're going to do is we're going to look at financial strength both within pure mutual fund organizations, so we're going to compare Fidelity and BlackRock, and within financial conglomerates, so we're going to compare Bank of America and Goldman Sachs. Now, for these different type of organizations, we're going to have different measures of financial strength because it's difficult to find one which fits both of these types. So for the conglomerates, we're basically going to use the CDS, which most of them have. And for asset managers, it's kind of hard to find a variable, but the one we thought was reasonable was an indicator variable, whether they have an investment grade credit rating prior to the expansion of the risk-taking opportunities. Okay, so these are the results for the conglomerates. What you do find is if the CDS is higher, so financial strength is lower, that indeed these conglomerates take on less risk, both in terms of holding risk, maturity risks, and spread. So higher financial strength means actually higher risk-taking. Okay? The reputation variables for this subsample work, but they don't work quite as well as for the full sample, which we think makes sense because the reputation variable is just calculated based on the mutual fund universe. So you're going to, in some sense, ignore the other business segments. When we look at the pure asset managers, what we find is that, well, first of all, the reputation variable works very well, which you would expect because, for them, I think we defined it perfectly well because all the other business they have are those other equity funds and bond funds. And the no rating variable works in the same direction, but is usually not statistically significant, okay? Which we think makes sense because there's just not that much variation in financial strength for pure asset managers. Okay, I showed you we're going to have some sort of out-of-sample evidence. One thing we can look at, and let's show a very short period, just this 1 week after Lehman went bankrupt, and there was sort of the run on money market funds. Before the government stepped in, we want to look at, well, did sponsors with more capital actually announce support for their funds before the government came in? And then were investors less likely to ask for redemptions for funds which did have a high reputation? And indeed, that's what we find. So if a fund didn't have a credit rating, it's much less likely to support its fund. And indeed, the reputations were smaller for funds which had high reputation. It could partly be because initially they didn't take on much more risk. It could partly be because you would expect them to be more likely to get bailed out exposed. Finally, one thing you might worry about is that the funds may still differ with respect to other unobserved characteristics which are correlated with risk-taking. So maybe risk aversion across the firm or of the manager, maybe compensation practices, maybe the quality of risk management. There's something different which we can't control for. Now, clearly, if these are time invariant, they're going to be controlled for with our fixed effect. And indeed, we don't find, as I showed you before, observable differences across funds beforehand. However, if they're time variant, you might still be worried about. Maybe some funds have better risk management. It doesn't matter during quiet times, but once there's this expansion risk-taking opportunity, it really makes a big difference whether you have good or bad risk management. So one thing we do is we actually look at retail funds as a placebo group. So one interesting fact, and you can see in the paper, is that retail funds don't respond that much to yield changes. We think that's consistent with the fact that retail depositors don't pay that much attention to these deposits, and they don't have that much deposits in money market funds. Okay? Usually the size of the deposit is much smaller than for institutional investors. So you find that the fund flow performance relationship is not there for retail funds. So it means the flows are less sensitive to returns. There's not so much of an upside. That means you shouldn't find the reputation of financial strength variable to have such an effect. So you can think of this as a little bit like a triple diff approach looking at retail funds. And indeed, we look at reputation where we find the reputation using the equivalent measures before, but for retail funds, and we don't find any effects. In some sense, they even go the opposite way, although none of these are statistically significant. One other thing we can do is eventually the government stepped in and decided to bail out these funds. Basically, the government decided to give an unlimited explicit guarantee for all money market fund deposits. Okay? So, well, that sort of, as a result of that, the link between the sponsor and the fund obviously doesn't exist to the same extent anymore. So the effect on risk-taking should be mitigated once the government explicitly guarantees these funds. So we're going to look at sort of 3 periods, our previous pre-period, our post-period, and then we're going to sort of look at a post-Lehman period. Okay? And when we do that, we find, well, our results are there in this post-period. So that's August 2007 to August 2008. But if you look in the year after Lehman, when this guarantee was in place, we don't find these results anymore. Okay? Now, we take into account that there were a lot of other things which happened after Lehman. There were explicit interventions by the Federal Reserve to support this market, but at least it's very much consistent that the change in risk-taking don't show up post-Lehman. Okay, we do a number of additional tests in the paper. I won't take you through them. So what I want to do is just conclude. So what we think we can show in the paper is that risk-taking of money market fund actually decreases with reputation. So fund sponsors, which had a higher franchise value, had more reputation at stake, decided to take on less risk ex ante, but it increases with financial strength. So if a sponsor had financial strength and was probably more likely to be able to provide support if called upon, they were willing to take on more risk ex ante.
And maybe one way to think about it is this is sort of a more microeconomic view on the role of bailouts within the private sector. So far, the literature largely focuses on the macroeconomics of bailouts, in particular the government, and there we mostly think about the moral hazard problem. Here we find that both reputation and financial strength play a role if you think about bailouts within companies. And that means, sometimes, it depends on financial strength and reputation. Actually, affiliation with a larger financial institution does not necessarily increase risk-taking, as some of the policy proposals suggest. Thank you.